Hello, welcome to Nonprofits for the Future, the Roadmap to New Funding Sources. I'm Drew Heckman, and you're in Module 3. In this section, we will discuss what financial projections are, why they're important, and how they can help you plan out your earned income ideas for success for the long term. Before continuing, you should have at least completed the following: all the Module 1 and 2 worksheets, the market size worksheet, and the pricing tactics worksheet. In addition, please download the Income Statement Excel workbook. We will have a demo to go over this in another section, but it would be helpful to have it open to have a visual for some of the concepts that I'll be discussing. A couple of quick definitions. Pro forma is Latin, and it means for the sake of form. It usually refers to projections in the financial space. So when I discuss the pro forma financials, I'm basically saying financial projections. An income statement is also called a profit and loss, or you may have heard it referred to as a P&L. It's basically an account of all the revenues, costs, and expenses that your organization has. Revenue is defined as money that flows in as a result of your earned income. Costs are defined as money that flows out, usually in the form of one-time items or costs that are costs of the production of your good or service. Operating expenses is money that flows out, typically recurring expenses that keep the lights on. As usual, look before you leap. Do your research, vet your idea, analyze and plan, and in this section, look before you leap means use the income statement to determine the long-term financial viability of your idea. So what's the point of an income statement? It is the financial tool to help you determine the viability of your idea. It allows you to plan, adjust, strategize, and create financial milestones. It also helps you make a healthy set of reasonable assumptions about your idea. Why else might you need an income statement? It could be useful if you're seeking investors through program-related investments or PRIs, or it could be useful if you're seeking a loan from a bank or a financial institution. You also might need one because it helps demonstrate due diligence and shines a light on any flawed assumptions that you may have made in other exercises. Finally, it provides concrete numbers to your plan, helps you get down to brass tacks and determine your bottom line. So what's in it? An income statement has revenues, costs, operating expenses, and assumptions, and I'll go through each of these. What else does it do? An income statement helps you determine if you're making a profit. It is your revenues minus your costs minus your operating expenses, and that turns out your profit or your loss. Income statements, quick note, can also be accompanied by a balance sheet or a cash flow statement, but those are both outside the scope of this course. If you're interested in what those are, you can certainly ask your accountant about them, but they're typically used if you're seeking investments or seeking loans. You won't necessarily need a balance sheet or a cash flow statement if you simply want to know if your idea is going to be profitable. Okay, let's take a look at revenue. Revenue is all money coming in. Be sure to include every revenue stream and product line. So maybe you have one product and you sell it in 4 different offerings: individual, 4-pack, 10-pack, and a 40-pack. Remember that price lining to point customers in the product offering direction that they can afford? Well, maybe you sell a different type of product also in similar packs. So you have widget A and widget B. And note that all of the money coming in on the income statement itself, each product line, widget A, would have its own category, widget B. And then each line underneath each of those widgets would have its own row for each product line that you have. So that 4-pack, 10-pack, 40-pack would have its each row. And here's the example. So you have widget A and widget B. Each of them are sold as their own in their own lines, individually, 4-pack, 10-pack, 40-pack. widget B is individually as a 15 pack and a 100 pack. And each of these would have different costs associated with them as well. So that's why you want to keep them separate in each of your lines so that in the income statement workbook, you can match up your costs to each of your revenues from widget A and widget B on each of the different product lines. Your costs are costs of production. So these are shipping costs, manufacturing costs, or costs of goods sold, also referred to as COGS. The basic idea behind costs is what does it cost you every time you sell one unit? So every time you sell one unit, what does it cost you? What are the costs that went into that one unit that was sold? This is distinguished from operating expenses. Operating expenses are overhead costs, the cost to keep the lights on. So these would be things like marketing, legal fees, salaries, or software costs. Typically month-to-month costs that are totally irrespective of goods sold. So every time you sell one widget, widget A in a 4-pack, for example, there might have been the costs of production, and that'd be in your cost section. The marketing, the legal fees, the salaries, the software costs, there was no cost in there that was associated with that one-time sale. You might have sold 100 of them or one, and all these operating expenses are going to stay the same, irrespective of how many you sold of that widget. And that's the differentiator between what are operating expenses and what are costs. One more time, costs are anything that is associated with that one-time sale, and operating expenses are things irrespective of sale, things that happen month to month and are ongoing: marketing, legal fees, salaries, and software costs, to name a few. Assumptions is its own tab that contains all of the revenues, costs, and operating expenses as well, but it gets down into the nitty-gritty. This helps you build out all of your projected revenues, the details of the cost per unit sold, and the monthly operating costs. This really helps you get into the weeds and forces you to justify why you put down the numbers that you did. This is the section where I really want you to challenge everything that you know. It really puts you to the test instead of just having those high-level back-of-the-napkin numbers. It also feeds the high-level income statement sheet. And I call these assumptions because you might look at every 3 months that you would expect to have $500 in marketing costs to run Facebook ads, and that only happens once every 3 months. But you assume that every month you'll spend $100 on your marketing budget for other odds and ends of things. So you would actually fill this out every single month: $100 in January for marketing, $100 in February for marketing, $500 in March for marketing. You would have a little note. You can even write a comment that says, this is because we run our quarterly Facebook ad in every 3 months. And again, there will be a demonstration on this, but I'm saying all this verbally to give you an idea of how it all fits together. I promised that we would take a look at an ideal pricing strategy, so here it is. This is putting everything together from everything that we've done so far in this module. To determine your ideal pricing strategy, you would first determine your value proposition or your unique selling point, your USP, using that social profit business canvas. You would then create your customer segmentation to match your customer pains to that unique selling proposition. Use the market-based pricing and then differentiate based on that segmentation. In other words, take a look at what your competitors are doing, price up and down from there, and then differentiate based on how much your ideal customers are willing to pay. Then input your projected revenue, your costs, your operating expenses, all based on your assumptions, into the income statement workbook. Finally, and this is kind of the fun part for math geeks, you can adjust your price based on psychology and cost plus strategies to see how it would affect your profits. An Excel workbook is meant to be dynamic, so you change one cell and you can see how it affects the rest of your profits. Finally, do a sanity check. If you have that you're making $500 million in year one, it's probably unrealistic. So you probably fudged the number somewhere or made an unfair assumption. Okay, doing some quick review. Pro forma is Latin for the sake of form, and it usually refers to projections when we're talking about financial pro formas. An income statement is a profit or loss, or P&L, and it's an account of all revenues, costs, and expenses. You might hear of a pro forma income statement or a pro forma P&L. That means a projection of your revenues, costs, and expenses all put together. Revenue is all the money that flows in as a result of your earned income. Costs are money that flows out that are related to the cost of production. And operating expenses are money that flows out, which are recurring expenses in order to keep the lights on, totally irrespective of the cost of production. Putting it all together by incorporating each of the things we've worked on so far, you get your value proposition, you find your customer segmentation or your ideal customer, you do a market landscape, you apply your pricing strategies, and then you take a look at your financial projections and your assumptions to see how much of a profit or a loss that you're making. Based on all of that, you determine if you want to move forward. Okay, that's all for financial projections. Please don't forget to give feedback in the Facebook group and to attend office hours. This has been Drew Hackman with Nonprofits for the Future, the Roadmap to New Funding Sources. See you soon.